What's up, everybody? Chris over here. And today I'm going to show you the overnight gap trade. Now, a lot of people get caught up in the idea of wanting to fade an opening gap or go with the gap in the morning, and that kind of lays out your entire day. This is different. What this is doing is it's actually taking the last few minutes of the trading day and then putting a trade on to catch it at tomorrow's gap. It's a challenge. Well, there's a lot of reasons why this one is going to this area. These overnight trades are really starting to offer some opportunities, swing trading and overnight trades, mostly because you got a lot of prop firms out there. And look, I'm not just talking about the regular Apex prop trading, but there's firms out there that have to worry about their overnight margin or their overnight exposure. And there are so many algorithmic systems out there that take advantage of the huge volume happening during the day and they go flat overnight, because when volume goes to nothing, having a big amount of capital exposed means you can't really get in and out. So a lot of the algorithmic trading stuff and the high frequency stuff especially is done during the most active hours of the day. Okay, so if you and me, I'll just say where I am as a trader. Okay, I'm a retail trader. I'm no longer running a fund. I am not affiliated with any firm. This is my capital and my own money. And so, I don't have rules of other people affecting my trade. So I can pretty much do what I want. So this is the S&P futures, S&P 500 E-mini futures. Now, if I'm going to take this trade, this is algorithmically generated trade here. Let's put this down. Algorithmically generated trade here on, now it's actually running on my server, but I coded it up into work on in TradingView so that the alerts can be visualized and we can get alerts in just a easier way to do it than from my server. Especially when we're like, you can see it when we're talking about server, we're talking about code, and it's not all that exciting to look at. You can't tie the visual representation to it. So, okay, here we go. So this strategy looks for a trade the last 10 minutes of the equities open, or the regular trading session for equities. Okay, it doesn't even take in consideration the futures last 15 minutes or so after that. So from the 3:50 to 4 p.m., it will look for a trade. Okay, if the conditions are met, which are conditions that have shown over time to say in a lot of the market regimes shown over time to work, it will put on a trade. In this regime, in this market, where we're at right now, it's a long only system. So we're looking for gaps the following day. Gap up the following day, gap up the following day, gap up the following day. For the last 2 months, this has been almost an 80% win rate. So 21 out of 27 trades were winners. And the profit factor, the amount of let's just read the amount of money strategy made for every unit of money it lost. Gross profits divided by gross losses. Okay. So for every dollar it loses, it gains $6.23 in the futures market. Now, this is where I'm going to get it. This is where I want to talk back to the idea of retail traders. Okay. One thing that is, okay, if you don't have a $25,000 account, options trading account, you can only get 4 0-day to expiration options. You can only day trade options 4 times before they shut down your account from putting on new trades, right? I think it's 25,000. So if you're running I don't know, let's say you do like a $5,000 account. You go in and you're like, I'm going to fade the opening trade and I only have $5,000. So I'm going to use options to get that good leverage. And you do it and boom, a couple of days in, you're shut down. getting to $25,000 from 5,000 is not something you can usually do in 4 trading days. Some of you could. But the point being is I want to look for an opportunity where less people are playing, where it plays to the strength of a trader who's not sitting on, a $5 million account or even a $25,000 account, to where, they don't have to trade 0 DTE options and sit here and stare at you. More importantly, you don't have to sit here and stare at your screen all day long. This for me is built so that I can do everything I need to do during the day without having to spend my whole day sitting in front of the screen trading. Okay. My trading is 99% automated at this point. And this is that last little percent that isn't automated because of the way I do it. Now, it could be automated if I was willing to trade a futures contract on this, but I prefer the leverage and the built-in stop loss ability of buying calls. So I buy 1 day till expirations. So at the end of the trading day today, I went out and I looked at what tomorrow's options were at the delta I was looking to trade at. I found that when the alert, so I know that within the last 10 minutes, I probably am going to have a trade alert. So the last 15 or 20 minutes or so, I'm in front of my computer and I have my trading software up. I have my option chain up, and I have the alerts. I'm monitoring my alerts in the Slack channel. So in essence, what my server does is it sends a message to the lab, the trading lab, paulnatetraining.com/lab. You can join us there. It sends it to the Slack. And as soon as that thing fires in the Slack, I go ahead and I just go find the option that I want to trade and I put it on. Yes, I will get that automated in the future. As they say, 10,000 butts to kick and only 2 feet. And you probably want to keep one on the ground to keep it from losing it. Okay, so what I'm looking to do here is, look, I can be in the car as a passenger, of course, and have my phone there, have my Slack open, see the message, flip to my trading platform on my phone, find the option I want, put the order on. It doesn't take much. Okay. You just need to be sitting in front of or you need to have your trading software and the notifications available at the last 10 minutes of the trading day and the first half hour of the following trading day. Because the second most important part the other important part of this strategy is when you get out. And so let's go find a trade that we did. It's pretty much been almost every single. Okay, so last week we had a trade. So at 5 minutes before the close, I'm in Pacific Coast time frame right here. Let me change it to New York so we're all speaking the same lingo. So at 3:55 p.m., the alert pops out into our Slack channel. Great. And it's a long order, of course, because we're in that regime. Cool. So I had 1, 2, 3 minutes of basically 4 minutes since the signal fired to that price went down. So if I use the algorithm to trade, it got long at 558 or 55.8850 on the S&P futures, but it actually took a nice 5-point dip. So anywhere in there, I could have actually got better fill, but that's not how this system's built, and that's neither here nor there. The meat of the move is from here, the close, until the exit. Now, this represents the whole overnight trade. So last Thursday, this was the opening bar, and it spent 17 minutes. It looks like 17 minutes after the open, it got its exit. So you need 10 minutes at the end of the day, and you need up to about 30 minutes. Well, it actually doesn't trade the first 6 or 7 times. The first little block where the most amount of volume is traded, it doesn't trade that time. Okay. It kind of skips over that because this is a lot of times, you know, at least in the data has shown that it's just a little too volatile. And so then you'll notice how quiet it really gets here for a little bit, right? It just started to kind of really mellow out. And so for that's what this thing's really looking to do. You can kind of see it's mellow, 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 and then it gets exciting down in here. This is when it gets into a trade. Exciting, 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 mellow, mellow, mellow. And that's when it usually gets out. That's kind of the feature of it. Okay. Now, the way I do it, like I said, is I trade it with options because I can be very precise on my risk. Today, for example, I bought, I'll see what it was. I bought 15 Delta calls expiring tomorrow. They cost, it was like 27 cents per contract, which is actually one contract is $27. Okay. So 10 contracts is $270 on this trade. So this trade enters at 55.8850 on the S&P 500 futures, which is what we use to generate the trade. But I'm trading on SPY calls. Okay. You can trade futures. You can trade the E-minis or the micros. You could trade triple leveraged, double leveraged. You could trade the stock itself. You could trade SPX options, or like me, you can do SPY options. Now, why am I doing SPY options? Well, one reason is they are the most liquid. There's more volume on the SPY options than anything else. I can get a lot of juice with the leverage, and the spreads are pretty tight. The difference being if you trade like SPX options, the spreads are like $2 or $3, I think, last time I looked. Kind of expensive. So, like $3.50 bid, $5.20 ask, or something like that. And it's just whatever. I don't know. I haven't figured out how to trade that in a way that I like. Also, there's options on the futures. There's a number of ways to trade this thing. At this point, as I'm getting this system from the initial testing for the last few months to going live for the last month or two to implementing it in with the Trading Lab members, because I'm not going to release a new system for them unless I've actually put some trading on and actually, gone through some of the bugs. So at least I can help if there's any issues, or try to help. But this one, for example, 55.88, and it exited at 56.26. So like a 40 point gain on the on this. So that's $25 times 40. So if you're trading on S&P futures, that would have been $1,000. I believe if you're trading the micro, it would have been $100. Here's what it was for me. So I spent 26 cents on them, on the options, and I sold them for 95 cents, if I recall, somewhere around there. So, like a 250, almost 300% gain. And again, if I had 100, or if I bought 10 contracts, that would have been 250, and I sell it out at 1,000, I, made 750, let's call it $750 profit on that. Not the same as $1,000 that I would have got from one E-mini. The thing is the margin rate on those E-minis is actually very, very high. So you would need to have something like, I don't know how much overnight margin on, see if I can find that really quickly. That is old. Okay. $15,000 is what you would need to have in your account to make $1,000 on that trade. But by doing this, all I need is the $270, maybe $280 with commissions and everything like that. And I can triple my money. Not that I'm saying that you would just put all your money on a single trade, because it doesn't always win, of course. And the one time you did that is the one time it blows up the account, of course, right? But what you want to be doing is, what I want to be doing here is I want to be taking low risk with asymmetrical returns. That's why I'm using 15 delta options too. So that's, 300%. And if I'm doing that on, let's say, half the trades that are winners, I get a, over 100% gain on half the trade. there is a place where it doesn't work so good too. And I know there was a trade earlier last week. This was another good one here. What do we get? We got 37. So it's a 30-point gain. That might have been the one. No, this is the one. 21 to 31. This one. So the entry was 56.21 or so. The exit was 56.31 or so. So a 10-point move. 10-point move would have been $250 on the futures. It actually, I think, lost money, even though the price difference was $10 on the futures. The premium that we lost through the overnight time decay, and since the price didn't really move that much, I actually ended up giving that money back. Or I didn't give them my back, but again, let's say it was $250. And I got out at probably $200 or maybe even $150. It wasn't great. I lost money, even though the trade was a winner. So this right here, this little chart, this little chart would show that as a winner, but in my actual account, reality, right? The slippage commissions and all these other things, the reason that I make that big, massive gainer that other day, it makes up for these. So I'm not saying that this is a perfect way to go about it. The perfect way to go about it would be to exactly trade the futures exactly the way it does it. But the downside is, you have to have at least $15,000 in that account for every contract you trade to hold it overnight. And there's a margin call issue. So you probably want to have $30,000 in there. And, when you're kind of looking at it, probably like 30,000 per contract or something like that to trade it. Not horrible, by the way. Not horrible. You can do that. You can absolutely do that if you're running a $500,000, like a large enough account, and you can just allocate a small portion to this one strategy. Just like anything, I want to have a small percentage of my account on all of my systems. So if I've got 10 systems running right now, I'm probably going to have something like 5% allocated, a range of 5 to 10% of my account allocated to that, depending on if we're talking swing trading or day trading or whatever. So I'm gonna have these different percentages allocated to each strategy, so that when they trade, we're gonna have 100 trades. If we compare 100 trades across all of them, some of the equity curves are going to be a little choppy. Some of them are going to be rampant. Some of them are going to be maybe dipping. But overall, the whole equity curve looks pretty smooth. So I wanted to show you guys a little bit more about the what this is doing. So this goes back till 2017, maybe. And again, this is using a futures contract here. So on a $50,000 account, one contract, max drawdown 20%. This is overnight drawdown too. This is max exposure. This isn't close to close. So you actually sit through the pain overnight with this equity curve here. And then in 2020, so this would have been the bottom, October of 2022 is when this happened. The worst drawdown of its life. And, if you guys were trading in 2022, this is kind of, you can see that 2022 was a bear market. Was it horrible? No, it had a max 20% drawdown, and a big one of that happened at the very end of it, which is indicative of bottoms. You can see the big drawdowns happen at the bottoms, typically bottom of the move. But if I was to overlay the S&P chart here, like 2018 to it's kind of right, I guess. Here, 2021, kind of right. This should have been a lot further down. I think it was a 34% drawdown. So that's only a 20% drawdown. So this is way outperforming S&P. Now, in the in the newer system I have, this regime is not traded. This strategy, it flips to a different strategy or a different asset to trade it. But for the most part, you can see that this thing is really pretty good. And yeah, this is August 5th right here. So that would have been that big mini crash we had 2 weeks ago. So let me take a look at some of these numbers here. So this is, like I said, 7-8 years of data, 20% max drawdown, close to close drawdown, 19%. So it's actually pretty close to what close to close. So return on max strategy. So every dollar down you move, you make 3.89 on the upside, which is a little different than the profit factor that we were talking about over here. So different. This goes for I mean, here's the profit factor 1.22. And again, that's including bear markets, that's including down markets, that's including, crashes and things like that. This also includes in our calculation slippage and commission in here. So if I took slippage and commission off, this equity chart would be gorgeous. And right now it's in a position. Annual rate of return, 23% annualized, which is kind of great. It's not horrible, I should say. But what I really like is this is almost a 2% monthly rate of return. Okay. And we're just talking about one futures contract on a $50,000 account, just trading. We're not optimizing. We're not using position sizing, risk management. We're not using options. Okay. So that's the key. The average monthly return is $900. I've made $900 on a single trade recently. Given that 10 contract example we were just talking about, it was $700 or whatever that example was. But let's say you have that same $25,000 account that you need to have to be able to trade intraday. You put on, let's say you risk 1% per trade. That's $250. $250, and your average, you probably, like I said, half of them end up being doubles with the options. So yeah, you could probably see a place where you are, yeah, you could probably double that account in a year. Pretty nice. I don't know, man. It's got a 55% win rate over here. Here's, this is the point. We're in a really excellent time for this strategy right now, 78%. And this, because it's TradingView, it only goes back so many bars, but like I could do, I don't know, ES U 2018. So like we go see what it looked like in 2018. So in order to like go back and get further data, you can see in 2018 had a 53% win rate with a 2.35. It changes over time, right? So, but TradingView only gives me the last like 2 months of 1 minute data. So that's why it's there. That's why I have this one to show you from another algo platform I'm using. Again, it's long only on the S&P futures. So if you want access to this one, this is what our members get. If you're a member of Pollinate Trading, and look, more than just this, you get a lot more than just this. It's, you join us in the lab and, you can see what people are saying about the lab, what they've done. You get access to our best systems. You don't need any look, you don't even need TradingView. All you need is a broker. I highly recommend you have a trading platform and charting and all these other things, but like you don't need those sort of things. My point being is you don't need any special software here. Okay. This is the overnight system right here. And you can see that's I think this is a little, a little shorter time frame, but it's the same chart. You can see the same drawdowns on it. This is the overnight system. You can get access to our swing trading NASDAQ system, which kind of went bonkers for the last few years, and even bonkers right through the bear market, where on the other one we had more of a sideways market through the bear market there. And then here's our swing trading system. for the Swing B system, which goes back, I can't quite see, but goes back, I think like 10 years. And that was our recent dip. So you get access to all these. The thing is, the alerts get sent to the Slack. You get the alerts, you put the trade on, you go out your way, or you hang out with, fellow lab folks. This is me saying, you hang out with fellow lab folks, and let's say we're doing this trade. Let's say today's trade came in, right? Like it did. And so what I do is I just go in there and I say, okay, I just bought the 564 calls for 26 cents or something like that. I put my trades in there. Other people are like, oh, I went with the SPX, or I did the, I actually went and did it with triple Q, or we've got some traders who are working at prop firms. But they have to have their position closed by the end of the day. And they just put that, as soon as the futures start, they put the trade on and they leave it. So it's kind of, that's how they're getting past it, but still using futures prop accounts. Look, if you want, this is just something I'm going to do real quick. Okay. Overnight gap research papers. Yes, futures. Okay, let's do that. Like, there are, I don't know how many of these we can find. Let's see. Let's go to the end of it, because that'll give us the trying to be fancy on my shortcuts. I think you can find, if they put references in here, they don't, they did not put references in there. There's just hundreds and hundreds. S&P. Okay, you can find overnight drift. Even the Federal Reserve writes about it. Cyclical arbitrage, mean reverting, overnight pricing. You can find like hundreds and hundreds and hundreds of papers. Let's look at this one, because there are, how many documents, or how many other papers are references? So what you can do here is just go and read every one of these if you want. Another thing you could do is, this was written in 2019, by the way. Another thing you could do, like 2018, this one was 1998. So this overnight gap strategy has been around for a very long time. You can go in, grab one of these papers, and give it to ChatGPT or something like that, and say, like, explain this to me, and then give it the next paper, explain this to me, give it the next paper, explain this to me. And then you could actually just drop them all in there and say, okay, build a trading strategy that takes advantage of all these sort of things. Like, you can do anything. The point is there's so much of this data on the overnight gap being successful, and that it's something that it's not such a big, it's not something that's easy to do. So like bigger, it's one of those things that it's an edge that you can drive a truck through, but it's also an edge that cannot be, it cannot take on huge amounts of capital. That's why it's great for us, I'm assuming, here, but it's great for personal accounts where you don't have to, manage corporate risk and all that sort of stuff. It's your own capital. I mean, look, Larry Summers, the R core team here, like there's some, S&P 500 or S&P Dow Jones, like there's some big firms, big places. We saw the Federal Reserve even wrote about this thing. It's an anomaly that exists in the markets, and we can just take advantage of it. Anyway, guys, as always, I love you all. Thanks for hanging out. Join us in the lab. Bye.